The growth stocks are being hated again. They're down 20, 30, 40, 50% from their all-time high. People don't really like them anymore. And this is where I'm starting to get interested in many of those stocks. One of those stocks is SOFI. SOFI right now is down around 31% from its all-time high. Just over the last few weeks, it's been absolutely brutal for a lot of the high beta stocks, even, Robinhood and many others. But mainly SOFI, I believe, is presenting a great buying opportunity at $12 per share. I'm going to tell you why, let you know my opinion and everything around it. So I really hope you enjoy it as always. Now, SoFi, you could say it's mainly a fintech or some kind of a digital bank. They have home loans, student loans, personal loans. They have SoFi Invest, which is a broker account, not as fancy as Robinhood, but it is a decent broker. They have SoFi credit cards and SoFi high yield savings account, and they have everything in one app. And that's why a lot of the younger people love them, because they don't need to leave the app if they want a home loan or they want a personal loan. It's always in SoFi, and it's pretty amazing. They grew members at a 53% CAGR over the last 5 years. It's been insane. 10.1 million members. And the main reason why I love the business model so much is because they only have to advertise to them one time. Once they bring you into the SoFi ecosystem, maybe for a high yield savings account, then they can cross-sell you personal loans, they can cross-sell you home loans, they can cross-sell you investment products for basically free. They just need to advertise once to bring you in, and those 10.1 million members, they can cross-sell them products. It's like a snowball for pretty much forever. And it's amazing, and it gets even more and more and more profitable over time. And that's why I love the business model so much. Revenue has been growing rapidly, 26% in 2024. Adjusted EBITDA has been massively expanding to 26%. 2024 was their first full year of profitability. They did 15 cents. It was a little bit lower because that includes some kind of a tax benefit, but they were actually profitable last year, and that was, very good for the company. Amazing stuff. Now, the main thesis with SoFi, if you're looking to invest in the company, is betting on their financial services and tech platform becoming a larger part of their revenues. Now it's currently 47%. The CEO intends to bring it to 100%. Now, the main difference is before now, when you get a loan with SoFi, SoFi has to hold the loan on their books. They have to hold the loans. They're taking on the risk of you not potentially paying them back and losing the value of the loan, and they're taking too much risk on their books. But recently, they started doing something else. They started originating the loans, where some other party is holding the loan. Another party takes the risks. They collect fees for originating it. So they refer you to someone else. They collect fees based on that. Then they collect servicing fees as you're paying the loan every single month, but they don't have to take on the risk. And this is the beautiful part about the business. So over time, SoFi will no longer be a bank. It will no longer have to hold all those loans on their balance sheet and take on risk. It will be more of a very efficient fee recurring revenue based business model. And this is where SoFi is going. Very recently, a few days ago, they did a deal with Blue Owl Capital to raise $5 billion in an agreement. And this agreement will have Blue Owl Capital hold the loans, and SoFi will just collect recurring fees. And if you don't pay the loan, then it's not on SoFi, it's on Blue Owl Capital. SoFi is taking almost no risk, but they're originating those loans and are collecting high margin fee recurring revenue. And this is going to give the company ultimately a multiple expansion. And this is the main thesis with SoFi. It's now 47%. It's ultimately going to become 100% based on the CEO. And something very interesting that the CEO said, and he said mainly that the company will eventually get a multiple expansion if they get it to 100%. And he said the reason why we wanted to talk about the business in that way is that its different revenue streams get different valuation multiples. And that's because they have different returns. And the fact of the matter is that the fee-based revenues are non-lending. They are higher multiple businesses because they require less capital. They're less risky, and they're dependent on less variables to drive success. So if SoFi is able to transition to a 100% fee-based recurring revenue business model, the company is going to get multiple expansion. It's going to be much more efficient, much less risky. It's just going to be amazing for the company. And the company and the CEO, they have a very good track record of putting in low estimates for them to beat. So they essentially put in 7 to 8 cents for 2024. Then they raised it to 11 or 12 cents, and they ended up with 15 cents, almost double their original guidance. This is what the CEO does. He sets low expectations so they can actually beat them. And something else for their track record, the company hasn't missed a single quarter in revenues. They beat 8 out of 8 quarters, and they haven't missed a single times. For earnings per share, they beat 7 out of 8 times, and they only missed once. So they have a very good track record of not just meeting, but even exceeding and beating those estimates and beating guidance, which is very important. If you're looking to trust the guidance of the management, you have to look at the record. And SoFi has an amazing record for not only meeting them, but even beating them by almost 2x, by a very wide margin. And for 2025, they put in guidance of 25 to 27 cents. The street was expecting 28 cents, and the stock sold off. But the CEO, again, he was trying to set low expectations. I would not be surprised if they end up with 30 to 32 cents, and he keeps raising it every single quarter, like he did in 2023 and like he did in 2024. So again, the market is short-term looking, and they don't focus on what the CEO is trying to do. But if you listen to him and you focus on what he did, I think it will likely be 30 to 32 cents by the end of the year, which is going to be amazing for SoFi shareholders. And that would put the company around 45 times forward earnings. Okay, but if we want to value SoFi, we have to look at the 2026 guidance of the management. And the 2026 guidance is 55 to 80 cents per share. They put in this guidance 2 years ago, and they keep reaffirming it every single quarter. They even said they're well ahead of their plans to reach 55 to 80 cents, and it's very, very achievable. So 55 to 80 cents per share by 2026, then 20 to 25% annual earnings per share growth beyond 2026. So this is very detailed guidance that we can use to value the company. Now, based on their guidance, SoFi is trading at 22 times low end of their earnings estimates, or 15 PE, or 15 times high end of their earnings estimates. So this is 15 PE on the high end, 22 PE on the low end, for 20 to 25% earnings per share growth beyond 2026. This is below 1-time PEG ratio, 1 time to price to earnings growth. And this is something you don't find very often with most growth companies, especially a company that's disrupting the banking system like SoFi is trying to do. So to me, this is extremely interesting for the company. And I'm going to give you my valuation model, let you know why I believe SoFi could 4x over the next 5 years. And then I'm going to tell you the risks with the company and everything around it. But for my estimates, I used the mid-range. I didn't use 55 cents. I didn't use 80 cents. I used 65 cents for 2026, which I believe is fair. Now, after 2026, I put in 3 years after that to get in a 5-year estimate. So because I do 5-year valuation models for 2029, and I put in 22% growth in those 3 years. I did not use 25%. I used the mid-range of 22%. In total, I would get around $1.18 in earnings per share 5 years from now. We take the $1.18 in earnings per share, and I believe 5 years from now, SoFi would be largely a fee-based recurring revenue business model. It would be much more profitable, and it would still likely be growing 20% in earnings per share. So I personally believe SoFi will likely trade around 40 PE. 40 PE, I don't believe it will be too expensive for 20% earnings per share growth and much higher margins for a fee recurring revenue business model. I believe 40 PE is fair. Now, if we time it by 40 PE, this is $47 per share. We divide it by the current share of $12. This is almost 300%, or a 4x over the next 5 years with SoFi. Now, maybe I'm wrong and it doesn't 4x, it does a 2x in 5 years, and it doesn't trade at 40, it trades at 20 PE. This is still not bad, right? I mean, you're still getting an amazing return on SoFi over the next 5 years. But I personally believe, the guidance will likely be a little bit higher, the growth will be a little bit higher. And if they do transition into a fee recurring revenue business model, the multiple has to be in the 35 to 40 PE range based on many different comparables in the space. Okay, now there's a few risks with the company that I want to highlight. The first one is a potential recession, because a lot of you are going to ask me, what if we go into a recession, SoFi is going to get killed and people will default on their personal loans and all these kind of things. Now you have to remember that SoFi isn't actually holding most of those loans. Other parties are holding the loans, and SoFi is mostly generating recurring revenue fees from those loans. Most of them, not all of them, but most of them. But they did talk about this, and they said our personal loan borrowers have a weighted average income of $158,000 and a weighted average FICO score of 744, while our student loan borrowers have a weighted average income of $134,000 with a weighted average FICO score of 765. So their borrowers are actually in a decent shape. I mean, 158,000 isn't really too bad. The credit score of 765 is very good. I mean, it's just excellent, you know. So their borrowers are in a very good shape. And yes, SoFi could get affected in a recession, but they have very good borrowers. They're not focusing on subprime or anything crazy like with the auto loans, which I believe are much more vulnerable in this downturn than what SoFi is lending to, and especially as they're not holding a lot of those loans. The second one is stock-based compensation. It's massive with this company, but as the company is getting more profitable, stock-based compensation has been going down. It went from 300 million to 271 to 246. So it's been steadily declining almost every single year. And this has, of course, led to some dilution. Like shares outstanding have been moving up around 8 to 9% per year, which is very, very high. But I believe, again, because the company just turned profitable, they just turned profitable now in 2024. As the company gets more profitable, it's still in its early stages of the cycle. Dilution should start coming down, and stock-based compensation should start coming down as well. That's what I think, but again, it's somewhat speculative, and we'll see what happens. I always tell you guys, if you cannot take the volatility, because yes, I said SoFi is a decent buy right now, but it doesn't mean the stock can't go to $8 or $9 or $10. It's very possible in a downturn. So that's why I always tell people you start small and then you buy in over time. Especially with volatile companies, it's much easier to manage than going all in and then blaming me if the stock goes down 20% and all these kind of things. So that's all I want to say about SoFi. Not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.